Really market moves in general. We're going to bring in Matt Roddy. He's Rockland Trust Vice President and Portfolio Manager. And Matt, when we take a look at what the Fed is doing today, the reaction in the markets, what's your take on this?
Well, I think obviously the market is being highly emotional here. And even when you do get some news that was being discussed with the Fed injecting the liquidity, it's just not rallying the emotions enough because every other headline is about something being closed or another issue with the epidemic. And I do think that, people just need to probably, reset themselves and feel confident that we're going to get through this. We've been through, 9/11, which was an unbelievably scary time. We went through the financial crisis, which was scary. And I do believe that, the preventative measures are coming down the road, and we will make it through. So I just think right now, everyone probably needs to take a little time out. I'm trying to tell our clients that, the time to, kind of get out of your seatbelt is not when the engine's stalled and the plane is going all over the place. You really want to wait till you're back on the ground and try and get through these emotional times. And then, I think as we reset over the next few months, and as I said, some of this information is a little bit more knowable. We can start to look forward to how do we come out of this, which will probably be a mild recession, but it's a matter of when and what does it look like after that. So
Matt, you think a mild recession? What does that mean just in terms of where we're trading today and how much lower you think we could go in the short term?
Yeah, I mean, we've come a long way down, right? We're down, in the mid-20s now. We're not actually hitting the lows of the Christmas Eve of 2018, which I want to remind people that, the S&P 500 is still above where it was 15 months ago, despite this precipitous drop. But, I don't think we have too far to go from the bottom. As they say, I think you can see it from here to some extent, but it's murky and it's a bit scary for people to think that way. But the mild recession, we should get a pretty good snapback because consumer lending is very cheap. The energy prices are very cheap. There's going to be people hurt with their jobs, and that's going to hurt for certain segments of the economy. But I think we see a pretty quick recovery to the economy, and quite frankly, usually the stock market comes back before that happens. So I would not be, as I said, getting out of your seat at this point.
Matt, I know you're saying that we could see a snapback here, but just in terms of what you're expecting in the short term, have you adjusted any of your estimates at all?
Yeah, I mean, you have to be bringing down your estimates. The only problem is it's really hard to see, hard to predict. That's why I think the fear's out there, the calculus of how many people are affected, how many things are canceled, what happens with the supply chain, what happens to GDP, revenue, earnings. I don't know how you get to an earnings estimate at this stage. The scientists haven't even figured out in a lot of ways how it spreads. And so I think you just got to hold on and you got to think about those things. But I think the market discounted a pretty significant hit to earnings, and that's clearly what should be happening.
Hey Matt, just in terms of whether or not this sell-off looks similar to what we've seen in other periods and what that could mean, just in terms of what we could see from a recovery standpoint, does this ring a bell at all to you, or what are you modeling your potential recovery after? Actually, it feels a little more like 9/11 than the financial crisis, quite frankly, if I was to kind of compare those two. 9/11 had a human element of fear and what's going to happen next, and this does too. And I think there's some of that going on, and that did snap back 2002 through 2004 pretty aggressively, and the markets rallied pretty well. And that was a little bit of a longer term bear too. So it might take us a little while to get out of it, but I wouldn't be surprised if we're not pulling out of this thing by the end of the year and feeling really good about 21 and 22. That's what I would expect. Matt, what do you like at this point? I mean, there's a lot of beaten down sectors. Some individual stocks obviously have fared much better, a lot of the consumer staple names, than many of the other equities out there. What are you buying in this environment right now?
Yeah, as I said, it's scary to be buying anything, right? But I think, if you are someone like us, we're not tactical, we're strategic. So the markets are down pretty precipitously, which means our allocations to equities are a little light. So, I guess we do gently wade in and lean into this thing a little bit, but we're doing it real gently with names that maybe aren't quite, maybe the growth engines of our portfolio, if you will. It might be someone who has low leverage and really stable earnings in the utility space, consumer staples you mentioned. there's some sectors of the economy that could benefit. Technology is not quite as hurt by some of this stuff, and some pockets of technology can be helped by the idea of telecommuting and working from home. But I think we're wading in gently into some of those areas. But I don't think it's a market timing mechanism. It's really about getting yourself back to targets in a way that you're comfortable. And if you really aren't comfortable, you probably shouldn't take those steps until there's a little more clarity.
All right, Matt Roddy, thanks for joining me.
Thank you.
Well, coming up, the